Hi class, and welcome to this video which is on the concept of double entry accounting. That's chapter 4 of the Macmillan textbook, and for many of you this is the first part of unit 3 accounting, which is new content. We're going to introduce you to some new concepts in this video, mainly debits and credits, which are an integral part of units 3 and 4 accounting, and the concept of the general ledger. Now, your first question you might have is, who the hell is this guy on this slide? This is the person that makes Year 12 accounting complicated, but he is in fact one of the most important people in accounting. His name is Luca Pacioli, and he invented this concept of debits and credits and double entry accounting. And he is famous for the saying that you should never rest your head, you should never go to sleep unless your debits equal your credits. And by ending this video, I hope that you understand what he means by that, and I hope that that becomes your mantra for the rest of the year in Year 12 accounting. What do I hope you achieve out of this video? The learning intentions are, and I hope that you understand and are able to apply this concept of debits and credits. And you're able to do this through the use of what we call analysis charts, which are just a way for us to analyze transactions and determine the debits and credits as we're learning this process. And when I talk about double entry accounting, we do need to go back to something that hopefully we are experts at, and that is the concept of the accounting equation. What is double entry accounting? Remember, accountants are not original at naming things. Double entry accounting is just a system that records at least two effects on the accounting equation as a result of a transaction. What this means is every transaction will affect at least two items in the equation. And this is why we call it a double entry. As I've mentioned before, accountants are not original at naming things. But this is integral to our accounting system. Why? Because I hope that you understand, and has been smashed into your brain all through Year 11 accounting, that the accounting equation must balance. And the only way for the accounting equation, which is assets equals liabilities plus owner's equity, to balance is have two numbers change. And the simple example, which I've used many times, is if we have 5 assets, it could mean that we have $2 of liabilities and $3 of owner's equity. Now, if I change one of those, like for example, I get $1 more of assets, I have done a single entry. I have just changed one of them. And what does this mean? My accounting equation does not balance. 6 does not equal 2 plus 3. So I must do a second double entry. And my options here are probably to say that that asset has gone up due to a liability. So I now have 3 liabilities, 6 equals 3 plus 3, or potentially it has been due to my business going up in value, so my owner's equity goes up, 6 equals 2 plus 4. So that is not new. Double entry accounting, analysing a transaction, determining how we're going to make our accounting equation balance because of this transaction is revision. What is new is some aspects of the accounting process that we're going to introduce. What is new is this concept of a general journal, and importantly, a general ledger. And I hope, especially in this video, that you become an expert at this concept of a general ledger. A general ledger is something that we record our double entry accounting and do a thing called a debit or credit. So we're going to now become experts at understanding, once we get our source documents at step 1, we're going to record this information in, firstly, a general journal, and then secondly in our general ledger. And after that, we then start to think about, how can I make reports, plan for the future, give good advice to improve our business. So what the hell is a general ledger and a ledger account? A ledger account is simply a financial record, and this could be as simple as a piece of paper that shows all the transactions that affect a particular item. And what do I mean by a particular item? any of the headings that you would see in a report. These could be any of your assets, your liabilities, your owner's equities, revenues, or expenses. And I don't just mean you list all your assets on one bit of paper. You're going to have a ledger account for your cash, your accounts receivable, your equipment, and so on. So every item that might be impacted by a transaction is going to have a separate ledger account. It's a record. So as I've just said, there is a ledger account for any line item in the balance sheet, income statement, and this could include bank, accounts payable, loan, GST clearing. All this ledger is doing is gives us a place to record all the increases and decreases of that item. That allows me to know, for example, if I'm going to focus on cash, for example, a really important asset that goes up and down all the time, I should have a record for that particular asset of any time it increases and decreases. And when I say general ledger, this is the collective name for all your ledger accounts. And this is where double entry accounting is used. I should have a record of everything that is in my accounting reports, and it should have records of any time these go up or down. So hopefully we've followed that, but I know that it's a bit complicated when we're talking about it. Examples are always better, and we'll get to that. But the bit that is new is what is double entry accounting in ledger accounts, and what does a ledger look like? We know that double entry accounting is a system that records the at least two effects on the accounting equation to make sure it balances. And we know then, if we think it through, that every transaction must be recorded in at least two ledger accounts. Because if there is two effects on the accounting equation because of each transaction, and there is a ledger account for each individual item that you might see in the accounting equation, it makes sense that it's recorded in two separate ledger accounts. Now, this is where it gets a little bit complicated. And this is where we introduce you to the concept of debits and credits, which for a small amount of time, hopefully, will feel confusing. We add a separate rule. For each transaction, we now say there must be a debit. So every transaction must be recorded on the debit side of one ledger and on the credit side of another. And you're probably going, what the hell is a debit and what the hell is a credit? And it's a really valid question. All we are talking about here is, in our ledger, the left-hand side is my debit side and the right-hand side of my ledger is a credit. And that's because our ledger account looks something like this. In fact, this is what it looks like in Year 12 accounting. You can see that I have essentially split my page in two with the same three headings on the left and on the right. The first one being date, the second one being cross-reference, and the third one being the dollar amount. And we'll come to the cross-reference in a second. But every time I get a transaction, I'm going to have one record on the debit side, and in another ledger, I'm going to record it on the right-hand side. And I'm going to record the date, something called a cross-reference, and the amount that this particular ledger has increased or decreased. Now, how do I work out whether it's a debit or a credit? Here is your table that will become your Bible. There is no real logic in terms of increases of debits, decreases of credits. All we have to know is that every time we have a transaction, there must be debits there must be credits, and our debits must always equal our credits. So for the time being, we will I hope that you'll write this table down. It will become your Bible. And after a while, in the next slide, I'll show you a way to remember it. But basically, if you have a transaction that increases an asset, let's say cash, that means you're going to record it on the debit side of your transaction, on the left-hand side. So if we have, for example, cash going up by $40, I would find my cash ledger. And let's say this happened on today, and I'm recording this on the 10th of February. And let's say my cash went up by $40, I'd record it like so. But if I had a transaction where my cash went down, I would record on the right-hand side because it's decreased. Now, when I say increases are not always debits, if we look at our liabilities, you can see that these are increased when we write a credit. So you can see that you're going to have to just memorize it to work through it. There is a way to remember, which means that you only need to remember one of these, because this can be quite hard and the exam involves debits and credits throughout. I recommend that you just remember the example I've just used, that if an asset goes up, it is a debit. And if you can remember that one and the heading PAYLA, you have enough information to remember your debits and credits. You're probably going, what is PAYLA? Hopefully you can have a guess that A equals your assets, L equals your liabilities, E equals your expenses, and R equals your revenues. Now, if you can remember that, you're probably going, well, I've missed one, owner's equity. P is not owner's equity. P is essentially owner's equity. It's another term, and it's proprietorship. Proprietorship, you might have heard of the term proprietor. That means owner, essentially just owner's equity. Now, if you can remember that, and you can put a little arrow like so, hopefully a bit straighter than that, and you might guess on the top, I'm going to think about what are my increases. Below, decreases. Now, remember the one that I asked you to remember, just one. The only one I asked you to remember was if an asset goes up, so an increase, it is a debit. That means an asset going down must be a credit. And if I can remember that, all I need to do is fill in the pattern of debits, credits, just going one after the other. And if you look back, you might remember liabilities going up were credits. And you can see here an increase to a liability equals a credit. And if you go back to the table in the previous slide, which I'll just show you now, it matches perfectly. So if you can remember assets going up are debits and PAYLA and be able to write this out, you can't go wrong. And I always recommend to my students that you write this down in Saxon exams, and it's the first thing you do in writing time. So how do we record in ledgers? We work out, is it a debit or a credit? Is it the left-hand side or the right-hand side? And we know that each transaction affects at least 2 ledger accounts, and the ones that I'm looking at here will only look at 2 ledger accounts. Hopefully you've understood, though, that these 2 accounts are linked because they reference the same transaction. And you might notice on the dates on the right-hand side, I have 2 records for the 1st of May and 2 records for the 4th of March. Not May. That's because there has been 2 transactions and they are linked. And this is where we come to our cross-reference. Because each ledger account has 3 parts, we're going to write the date, and the date is the date of the transaction, the date it's occurred. The second one is our cross-reference, and that is the name of the other account affected by the double entry. We call this a cross-reference. Hopefully you're starting to become a bit familiar that you recognize this vehicle ledger I've recorded on the left-hand side, so I've done a debit, because left-hand side debits, right-hand side credits. Hopefully you've understood that vehicles are assets. Now there is another thing that's happened. The vehicle has increased by $16,000, but there's another side. How did my vehicle increase by $16,000? The cross-reference links the other side of the transaction, cash at bank. And if you look at cash at bank, which is also an asset, on the 1st of March, I have $16,000 again, and it says cross-reference vehicle, because these are linked. They have crossed the ledger. It allows us to link between the accounts, allows us to identify the other account affected, and it allows us to determine errors. So what happened on the 1st of March? Let's think it through. On March 1, I purchased a vehicle because my asset has gone up, for $16,000 of cash. And I've deliberately excluded GST in this one, just so we get an understanding of it. What happened on the 4th of March? On the 4th of March, my bank account again went down because credits of assets go down when I write a credit. They went down by $400 and my cross-reference is wages. So how could my bank account have gone down by $400 that's impacted by wages? Well, I simply paid wages of $400. And if I look at the next ledger, I have wages there and expense. Expenses have gone up with debits, and this has gone up because I've paid it, I've recognized it. And this is how we start to use it. Now, this is obviously a bit complicated. It's new. We still have to practice it, but that's the power of debits and credits. It allows us to have a more sophisticated recording system, which allows us to make better reports and analyze a business quicker and look for errors. So what's the process that you follow? If you follow this process and understand PAYLA, you can't go wrong, although they will involve some practice. When you see a transaction now, step 1 is to determine the ledger accounts affected by the financial transaction. What accounts are impacted? Nothing new. Part 2, you're going to classify the accounts according to their balance sheet. Is it an asset, a liability, owner's equity, revenue, or expense? You're going to do nothing new in step 3. You're going to work out, has it gone up or down? Then you're going to do the hard part of going, if I know that my, for example, liabilities are going down, you need to refer to the rules of debit and credit and state whether they have this increase or decrease is a debit or credit entry. You then record it in your ledger, and afterwards or before you record it, you're going to double check and make sure, has this way I've analyzed this transaction, has it resulted in my accounting equation balance? If so, tick. And my analysis of debits and credits, has that resulted in my debits equaling my credits? If you follow those 5 rules, and remember PAYLA, so you don't have to memorize anything, although you'll become really good at it, that's how you do double entry. We can, though, use an analysis chart originally to help it guide us in our thinking. And as we become better at it, we won't use a formal analysis chart, but the skills stay the same. You just do it on a scrap bit of paper. So let's look at 3 transactions. And we have to go, what's impacted? Is it an increase or a decrease? Is it an asset, liability, or owner's equity? And knowing all that, what are my debits and credits? So the first one is the owner contributes cash to commence our business. Hopefully we become really good at recognizing that means our cash goes up and our capital goes up. And our cash is an asset and our capital is owner's equity. And as I've just said, both of them are increasing by the amount of $65,000. Now using PAYLA, that means our debit is cash because assets going up is a debit, and our credit is owner's equity because owner's equity increasing is a credit. Our debits equal our credits. And we've correctly worked it out. And then we can start to think about, how do I record this in my ledger? I have to work out my cross-reference for cash at bank. My cross-reference must be capital because it's the other part linked. My cross-reference for capital must be cash at bank because that's the other side of the transaction. When I'm doing a credit, my cross-reference is what is my debit, and when I'm doing the other way around, it's what is the other side of the transaction. And that's the process. So if I borrow $25,000 from West Bank, for example, the two accounts impacted are cash at bank, my bank account goes up, and a loan. The cash is an asset, the loan is a liability. Both increase because my bank account goes up when I get the loan, but the liability, I have a new loan, I have an obligation to repay that at a future date. Assets going up, debits, liability going up, credits. So I'm going to record the debit on my left-hand side. So we can start to think this through, and my credits on my right-hand side. Finally, we have bought GS inventory for $600 plus GST. And this is the first time I've included GST. So here we have not 2 transactions, but 3. My inventory is an asset and it goes up. My GST is a liability because I am buying something, I am paying GST, and this reduces that liability. And my cash clearly goes down because I'm buying inventory. So my inventory goes up by $600 because I bought inventory of $600. My GST clearing decreases not by $600, that is a mistake, but by $60. And because I'm paying it, I owe less to the government. And my cash goes down by $660 because I'm paying for $600 of inventory plus $60 of GST, so $600 of cash. Assets going up, debit. Liabilities going down, are debits, and my cash at bank goes down, which is a credit. My debits equal my credits because I have 2 debits and 1 credit. It's not the amount of debits or credits, it's the number. 600 plus 60 equals 660. That equals my ultimate credit of 660. My debits, again, equal my credits. We can then pick that information up and start to build our ledgers. And we'll do heaps to practice that in class. We have some more revenue and expenses. I am just going to put these up on the video for you to follow because it's become quite a long video. But in my class, we will go through these slowly. Hopefully you are able to follow these ones around. These are expenses and revenues impacted, but the same process. Revenues and expenses. What is the impact? The one thing to remember about revenue and expenses is that they only ever increase. It's very, very rare that you're going to have a revenue expense going down. So even though the expenses are potentially a bad thing for the business and they do decrease owner's equity, they decrease owner's equity by going up, 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 and up. So these only ever increase. So you can see for my expenses, they have all increased. My revenues have all increased. And there's never been one where it decreases. and that will only happen very, very rarely, and we'll explain those in much later in our course. For now, I hope that this video has helped you found a useful introduction to debits and credits, and you're feeling confident and you understand debits and credits, and now you can start to apply them in analysis charts and start to become an expert at recording these in the ledger. A new skill which will take time to master, but now's the time to practice it.